Recording in progress. Greenwood Stocks coming at you with a video. It's been a while. I want to talk about some things we're doing, some philosophy shifts, some different things that we're looking at, some methods, some trading strategies, so that you can kind of be abreast on the latest that we're doing. So, of course, we want to bring you the best ideas, education that we have. We're looking at options primarily, so you can kind of get some knowledge. Again, we do have our premium options channel, so if you want to subscribe for that, it's very cheap, reasonable, $9 a month or $60 a year. You get 2 free months if you sign up for the whole year. So definitely click the link in the description and sign up for that if you want options plays. And without further ado, we want to kind of look at the trends that we're seeing in the market. So first of all, the overall market is gonna always play a big part. As a trader that trades momentum and short-term swings, I always look at what's the biggest gainer. But if you're playing options and you're also having to look at different elements, then you always want to know what the overall market is doing, because it dictates what the smaller stocks are doing. And so, of course, we see the tops so far on the SPY. And so the SPY, if you don't understand, it's the S&P 500 ETF. And this is kind of, it's an index, it's an ETF, and it lets us know where we are in the market. So we see big sell-offs. This was indicated by the Omicron variant for the COVID, and we want to keep in mind what's going on here. So basically, this is indecision in the market. The market is saying we don't know whether we want to sell all the way off. We don't know if we want to just make a new high, or we're just going to stay somewhere in the middle until we decide what this news means. The biggest headlines are the Fed tapering, buying assets, raising interest rates. Everybody's waiting on that. And once that happens, of course, the market probably will go a lot lower. We have inflation issues, big $1 trillion issues with that. So, we're looking at these different elements that are going to make up where the market is going to be moving in the next weeks to months and even into the year. So without further ado, though, we were looking at trends where, number one, retail is selling off hard. We saw retails make huge highs before. You got Macy's, you got Dillard's, DDS, you got all of these stocks, Dollar Tree. Look at how all these charts are almost the same. Dollar Tree is holding up a little bit better, but it's still about $12 off the high. And so we're looking at a market where retail is just selling off. You see, even Ross Stores, they reported a really good quarter, and then they sold off. Okay, so basically, I was playing this on the long side, and even though they blew it, look at the earnings. They blew earnings out. $100.09 versus 78 cents. It's like 25%, and then they beat on revenue with $4.5 billion. But they talked about the uncertainty related to supply chain. So that caused it to go from 123 to the low of 104. So looking at this trend over and over and over, you have to start anticipating these things. So for example, DocuSign, DOCU. Now, DocuSign is a tech stock. When the pandemic first came, everybody was going to be at home, and you're going to have electronic signatures and things like that. So DocuSign has a lot of institutions holding it. The problem is, we're coming out of the pandemic. So these tech companies are being traded based on the future potential. Now they're not as in focus because things are back to normal, more normal than before. So these stocks are basically looking to sell off, and this is the biggest trade I've ever seen. Puts on this stock were going at a max of 118,000%. So that means for every penny that you spent, you would get $118. Okay, $118 for every penny that you spent. If you invested $1,000 and you bought 145 puts, you would have $118 million. All right. So that's just the power of these puts and the power of big moves. But you know, we've traditionally been on the long side, and at this time, at this point, we just cannot afford to only look at one side of the trade. All right. So I'm going to show you some examples of this, and then Intrinsic going to ask some questions, and we're going to walk through just a few key plays that we see setting up and what we want to see moving forward. So again, just to give you an example, last week, so you see that these strike prices, I didn't see this before because the move kind of came out of nowhere, but these puts were going for 1 penny. Okay, they were going for a penny. By the time this move was made from $2.23 to $1.34, those puts went from being worth 1 penny each to being worth, I believe, $18. Okay, which means it went from you spending $1 on a put and it ended up being worth $1,800. Okay, so again, they reported good. Okay, they reported good, and they actually beat earnings by quite a bit. I'm trying to get it back out. So yeah, you know, they went to this is the guidance. They went above expectations. They did guide lower, so that has something to do with it. And it's so much news I can't even get to. But they beat it. They actually beat earnings and revenue, EPS and revenue, and then the stock dumped about 50% or something like that. So again, when we look at what's going on, okay, so how can we get positioned for the next move? Well, right now, everything is kind of selling off some. You know, even Moderna, you know, even the Modernas, I mean, from the highs around 400 all the way down to 265, you know, Pfizer will sell off, EV, you're looking at Lucid selling off. So everything the market is feeling like everything's reached its peak. So you cannot buy stocks like you could, you know, at the beginning of November when things looked like they were turning around. Hope that makes sense. So I want to give you an example from the day. COUP. So right now we are playing earnings because we see that earnings, whether they beat, whether they miss, earnings are selling off, especially in tech stocks and retail. So what we want to do is look at every earnings play that's coming up and see if it makes sense. This is our premium options. See if it makes sense to get in. Okay. On earnings. And if it does, we want to position ourselves with maybe a small position. And then, you know, with that small position, we can look at, you know, what makes sense. So AutoZone's reporting today, COUP, C-O-U-P. COUP was reported. CONN is reporting tomorrow morning, I believe. Sumo is reporting. And so we got a few to play. Now, for example, COUP. Now, we got in COUP because, number one, it's a software company. Number two, they have lots of debt problems, okay? They're not earning. They haven't turned a profit. That is mirroring the type of company that DocuSign is, okay? So they do different things, but it's similar, and it's in the same sector, okay? So again, we see them reported. They killed EPS, 31 cents versus 18 cents. Okay, they beat revenue 185 versus 178, and then they still sold off. Okay, they closed at 175 and sold off to 152 at the low. Okay, and they may sell off even more tomorrow morning. But the bottom line is, once you see a pattern, you have to take advantage of it. Now, so we position ourselves here. We position ourselves for CONN to see if if there's a similar price action around CONNs. A big one we're watching today is going to be Lululemon. So with Lululemon, with them getting crushed, I mean, people are obviously anticipating possibly lower earnings, but again, we're a little late, because we should have been, once we see this new high, we should have been looking at getting a position. And once we break down below this trend line is when you want to start your position, basically. Okay, so I mean, that's pretty much it. Lululemon reports Thursday, I believe, and we think it'll be a big sell-off. So what can you do about that? Well, so glad you asked. It is 420, so close to the money. You're looking at really expensive calls. The way the safest bet is close to the money, but you see these calls are going to be $1,600. Okay, out of the money is much more riskier and a higher reward. Like I said, on DocuSign, they had strike prices for a penny. They had 1 penny strike price on 145. It actually got in the money, and you could have made 118,000%. But on Lululemon, do we think it's going to fall from 430 all the way down to, you can't even see the twos on this chart? Do we think it's going to fall all the way down here? Probably not, even though it can. So you want to gauge what your risk reward is. If you want to buy closer to the money, but remember, if they surprise and they go up, then you're going to lose most of this premium. If they go down, if you're on the put side, if you're on the call side, of course, you want this going up. Okay, we're looking at same thing, $1,200 for a call, and then if you really expect this to move, you can buy you can buy way out of the money calls for $500 strike price, 60 cents, and if it gets deep in the money, then you're looking at 1,000%. So that's pretty much it.
And I guess that's one of the questions that I always have when I'm looking at the puts. So if you buy in that example, so if you buy the $200 put strike price, and let's say it goes, it's 423 now, let's say they report bad and it goes down to 400, like what would you be looking at profit wise from that move, considering it's so far out of the money?
So they don't have a $200 strike price, but we'll just do 260.
Yeah, 265.
Yeah, we'll do 260. So they're asking 30 cents. So you would basically pay 30 cents. Okay. The next day, no matter what, this 30 cent is going to be cut in two, because the theta, which is time decay, is going to take half of that, or almost half. Okay. So the delta is how much it's going to move per dollar. So basically, for you to break even, you're going to have to cover this premium, which is 30 cent. You're gonna have to cover this 14 cent, which is gonna be subtracted from that, and then the delta is gonna have to be, basically, we're looking at 14 cent and 30 cents. So it's basically going to have to move at least looks like 44 cents, okay, for you to $44 for you to break even, because it's out of the money. So you're not anywhere close to in the money. By the way, this blue shaded area is in the money, and they normally make it a little bit easier for you on these different platforms. So again, but say you're playing 400 calls, you pay $10.25 for a call. Again, immediately a fourth of that, because these are weeklies, these are a lot of those basically. So a fourth of that is going to be subtracted per day. You know, it's $10. You're losing $2 a day. So this, and then the delta is 29 cents. So pull out my calculator. Whenever the stock moves, it has to move enough to make up this theta and the delta. So again, if the delta is 29, if the delta is 29 cents, that's pretty much 10x, or divided by 10 for your theta. So if you divide this by 10, this lets you know that it needs to move at least $10 for you to break even on this trade. Okay, so and if you look as well, if you go up $10 close to the money, you will see exactly what I'm talking about, because $400, the ask is 1025. Okay, so if you go up $10, which is what we calculated is what it would take, now you're somewhere between 1285 and 1380. But remember, every day you're losing $2.37. Okay, so real important, you're losing $2.37. So the move has to be at least the theta every day for you to keep up with the time decay. Does that make sense?
Yeah, I got it. Yeah. So so you pretty much can only really hold these 2 to 3 days max if it hadn't made the move you wanted to make to even make it make sense.
Yeah, max. And that's why we say start green, stay green. You know, we got to be sure that we're on the right side of the trade. If you're, like I said, these weeklies go fast. If you want more time, you know, you can get a longer time period, let's say December 23rd, but they're going to be more expensive, but it's also going to be less time decay, because, well, it's not a good example because these spreads are way too wide. But yeah, we'll go here. So here you're only getting maybe 10% or 9% time decay. So you get twice as much time as you would the same weekly. Now the delta is not as much, because guess what? You're buying time. So it's not going to reward you as much for a big move, but you also have more time. So, you know, it's just, do you want the cheap options with a shorter window of time, or do you want the more time and more expensive options is always the question you got to ask. So going back up to Lululemon again, but now key point, you don't have to worry about theta. Well, I guess you do. The closer you are to the money, the less you have to worry about theta. Now, once you get all the way in the money, or deep in the money, a lot of these stocks won't have any theta. Okay, but on this particular one, it does. Let's look at DocuSign. So yeah, with DocuSign, it's almost negligible. Look at the call side. Whenever we are in the money, you see $15. The theta is not really is really a factor. You see this theta, and I mean, compared to the previous theta, you know, you had a $2.50 that was being subtracted from a $12 option versus 39 cents being subtracted from a $30 option. So the theta either goes to zero or it slows down quite a bit. Okay. Now look when you go out of the money here, the same thing. The theta is 67 cents. So it's 6, 12, 18, 24. It's 25 cents of the ask. So keep in mind, once you hit the money, once these stocks get in the money, you know, everything is better. The delta is big. The theta gets less, and then you make more money. I mean, you see when it goes from 15 to 25 to 30 to 35. The deeper in the money that you get, the better. Again, but you have to decide if you want more time or if you want the cheaper options. So does that make sense?
Yeah.
So on COUP, that let's look at this for example. So with COUP, I bought $100 strike price. Okay, so with the $100 strike price, look at the theta. The theta is pretty significant. The theta is minus 61 cents. So automatically tomorrow my option is worth a half of what it was today. Okay, approximately. Okay, the delta is 5 cents. So what is 61 divided by 5? 61 divided by 5 is 12.2. Okay, so that means that this theta is 12 times the delta, which in the delta is how much the stock is moving per dollar. Okay, so that lets me know that I need at least a $12 move to break even and cover this theta, because I got time decay that I'm trying to outrun. Okay, so far this stock has moved down $20. It closed at 174. Now it's at, let's just say 154, 155. Okay, so I'm profiting, but not by a whole lot. It's going to have to move down a lot more for me to profit. But look at the risk and reward. Now we're using DocuSign, DOCU, as an example because of the move it made. It had 240. The lowest calls were 145. So they hit 145 and then they went even lower to 131, which made, like I said, a 1 penny contract, 1 penny contract be worth $18. That's how far it got in the money. So say DocuSign wanted to dump again the $60. Say bad news hit $60. Again, let's go 15, because $60 is $15 in the money if you bought a $75 strike put. So let's just say we closed at 145, so 160. So you see again, this $2 put, now it's very unlikely, but this $2 put is going to be worth $18. Okay, because you see $60 is 15 from the strike price, $15 in the money. So we can estimate how much you would get by going $15 in the money from where it is right now, which it's 145. Let's just say we're going 160, so $18. So again, you're taking two pennies and you're turning it into $18 for every single contract that you buy. So that's the power of these options and buying puts and buying calls. And like I said, right now, we also got in PFE, and I realized that I believe that I should have been looking at Pfizer probably earlier, probably a little bit earlier. But right now we got puts on. We're already up so far. So once it breaks this resistance 50s, then we can see a nice fallback. So again, we're not long, we're not short. We want to be right, because we've been long too much, especially when the market tops off and then it goes down. Why not make money on both sides of the trade? So any other questions?
I think that pretty much covered it on my end.
Yeah, so let's summarize it. Basically, whenever we're buying calls, we want the stock to go up. So from let's say we got a $52 call, 90 cents. But again, you always have to look at the theta and the delta. The theta and the delta are the most important things. The delta is going to tell you how much you get if it goes up per dollar. The delta, the delta is how much you get per dollar. The theta is how much you're losing every single day. You have to get at least enough money to cover the theta every single day. It's like paying bills. It's like paying expenses. Okay, you got to make payments every month: rent, mortgage, car note, whatever the case may be. Okay, once you get to the money, it's a whole different ball game. You get to enjoy this big delta. The theta gets smaller, and you see where you can turn a whole lot, 38 cents, into a little. And the thing I like, and you have to look at this, you have to go and research these structures, because it's just like anything else. The chart, the share structure, how many shares are afloat, how many institutions are holding, things like that. You have to do your research, because with Pfizer, with Pfizer, they have a pretty big delta. So you can invest $1 and get 50 cents for each dollar movement. Each dollar movement, you get 50 cents. Some stocks are only 4 cents per dollar movement, even though you're expecting a big move. So I like the delta to be as high as possible. That way it doesn't have to move that much for me to get paid, because right now the delta is 50. Right now on my strike price is actually more than 50, about 60%. So I'm getting 30 cents. I'm getting 30 cents for every dollar that my stock moves. I only pay 50 cents for the call. So for me to double up, I'm going to need I'm going to need a $2 move to basically not double my money, but make a profit. Okay. Some stocks you need $100. Some stocks you need a $30, $40 move, like on COUP. Okay. But with Pfizer, I know I only have to see the stock go to $50 before I get in the money. And once I get in the money, then I get to have, 50 cents, $2 for a call I paid 30 cents for. We actually paid 38 cents for this call. Right now they're at 53 cents. So we've almost doubled our money already. Once it gets in the money, they're asking $1.17, $2, $3. So that's how you multiply your gains really fast. You got anything else?
No, I think I got a pretty good grasp now.
Yeah, so like I said, always look at the delta. Again, if you buy out of the money, the problem with buying out of the money is that, number one, some of these don't even have any bids. So if you pay 6 cents, if you load up on call 6-cent calls and the stock never gets there, number one, every day you're losing 2 cents. Number two, the delta is not moving. So you have to get at least a $6 move just to double your money, when here, if you get a $1 move, you're getting about 50%. Okay. So again, if you're going deep out of the money, that's the way you multiply gains a lot. Huge gains, 1,000, 2,000, 20,000%. That's what happens, because you're buying these stuff. Say Pfizer has a huge FDA problem, okay, in this stock tanks. Well, these stocks, these options, these puts that you paid 1 penny for are going to be worth $1.17. So that's 100 times your money. Okay. So this is how you 100 times your money. If, again, you can't predict this kind of stuff. Nobody thought that DOCU would blowout earnings and then fall all the way from 220 to 131. That's not really predictable. But if you happen to be already short this stock, or you happen to think this stock is going on a downtrend and you're in it, then you can get this kind of move as a surprise sometime. So that's pretty much it. ISIG, talking about stocks. I mean, we haven't really seen multi-day runners. So again, we don't want to be, the name of the game right now is taking profits. If you're not taking profits, you're going to get left behind. They are going to explore strategic options to maximize shareholder value. Anytime they say maximize shareholder value, you can expect a big run. And the stock only has a 1 million share float. So again, you're looking at this stock making a huge move. It will be back close to where it came from, mark my words, in the next day or so. And if this stock had options, which it does not, we will be buying puts, because there's no real reason why this stock should be 200% higher just because someone said they're going to explore a strategic option to maximize shareholder value. That's not adding money to the company. That's not adding value to the company. That's just an announcement of what an executive says he wants to do. Okay, we all want to add and maximize, our value and the things that we have value, but that doesn't mean it's going to happen. So this is all speculation. This is why shorts win so much, because they can get on these stocks. There's no real reason for it to be up besides algorithms and mania. And then, it goes from 15. It's already $12 now. And so tomorrow they could drop an offering. They could get bad news and it's right back down to $7 and you made 100%. Okay. So that's pretty much it. We hope that was not too technical for you, but again, the main thing, understand options, understand the chain and what makes the options valuable and less valuable. And then also understand, don't get tunnel vision. Look at different trades from both sides. We've been taught to only go long, which is 90% of what traders do. We only go long, but again, everything that goes up must come down. Even your Apples, even your Teslas, even every single company that we've seen, at some point, what goes up must come down. You see Apple go from 80 to $55. You see Tesla, which some of these stocks are starting to move downward too. I mean, Tesla all the way down to $2. Tesla was at a high of 1,200, and now it went into the 900s. That's 30. That's a quarter of its value just in a couple months. So understand, if you are on the short side, you're going to be right, especially when the market is topping out, more than you're wrong. When the market has sold off, before stimulus, before a lot of news, before stocks start rebounding, you want to be long, but look at where SPY is. SPY, look at where SPY is from the pandemic at $200, and now it's double. Like how much higher can it go before we get a correction? It tried to correct back in October, September a little bit, and then we just went to another high. You can't just keep making new highs year after year after year without some kind of correction. And the next catalyst will be Fed tapering, interest rates rising, inflation, and things like that, plus lower earnings. That's gonna have this market correct. So just be ready to be on the right side. That's pretty much it. Hope you learned something. You can always email us, greenwoodstocktrading@gmail.com. You can send us a DM on Twitter. You can join our Discord. Click the link in the description. You can click the link on Twitter for our premium options channel and our website if you want to get educational information on options, on the basics of trading, etc. We have all that for you. And till next time, God bless. We'll see you on the green side.